Hey everyone, Matt Sines here. Today I want to take a moment to see whether or not it's worth it to buy down your interest rate, pay points when you're refinancing to a 15-year loan. So what we're going to do is we're going to compare two loans, a 15-year term, one with points and one without points. So we're going to make that comparison, run the numbers, and see if it makes sense. The reason why I bring this up is that I'm seeing a lot of times in the marketplace, especially online, you'll see these lenders with super low 15-year rates, but it comes with points. And most of the time, spoiler alert, it doesn't make sense. So we're going to run through the numbers, make sure when you're doing a refinance of any sort, but especially with a 15-year, your lender, your loan officer is running these numbers, making the comparison so that you are, it makes sense to do the refinance because really you don't want to do it unless it makes financial sense. So, and also keep in mind, everyone's situation is different. So this is just a hypothetical. Your situation will vary. But for the most part, what I've found is that buying down the interest rate on a 15-year loan doesn't make sense. So let's run the numbers and show you exactly what I'm talking about. All right. So I'm using just a simple points calculator. I subscribe to this service through MBS Highway. They have a whole plethora of tools that I like to use as a loan officer, also some other services. But you can typically find a points calculator on the internet, or again, ask your lender, ask your loan officer. That's what they're there for. So hypothetically, let's say you have a loan amount of $400,000 and the interest rate without points, so you're not buying down the rate, the par rate, as we call it, is at 2.5% over a 15-year term. And that's typically, as of this recording on December 29th, 2021, that's roughly where they're at. Obviously, interest rates will vary based upon your situation and your credit profile. But that's roughly where they're at right now. And it is for a 15-year loan. So let's compare it to, now let's say that you pay 1% of points to get a rate at 2.25%. And that's roughly about how much your rate's going to go down with a 1% discount being paid. Now, that can change, it depends upon what's going on in the market. But just for this scenario, let's take a look at that. So we run the calculation. Let's take a look at the loan without points. So we have a payment of, this is principal and interest, $2,667, and total interest of about $80,000 right here. So let's compare that to, just on the surface level, interest rate at 2.25, paying that 1%. Payment does decrease. It's $47 lower, which is, that's something. Probably not going to kill you on a month-to-month basis. Total interest is at $71,661. So it's roughly about $8,400 difference in terms of total interest that you're paying over the 15-year period, which, that's something over 15 years, but even then, it's not that much. And keep in mind, you're paying $4,000 to get that. So really, the net savings is about $4,400, which over 15 years, it might not make sense for your situation. Because ultimately, when, just like any financial decision, what you want to look at is the opportunity cost. You're using that $4,000 to get a lower interest rate. What else could you put that $4,000 to? So let's look right below here. One of the most conservative things you can do with that money is just to pay down your mortgage. So instead of a $400,000 loan, we have a loan amount of $396,000. Still have the interest rate at 2.5%. Payment goes down, but still a little bit higher, still $20 higher than the lower interest rate. But here's what I really want to point out, that the total interest is at $75,287. So the difference between these two is less than $4,000. And what that means is that you're actually saving some money from an interest standpoint when you put it towards the mortgage instead of buying down the interest rate. So we look over here, the break-even point is 199. This is a 180-month term. So it doesn't make sense in this situation to buy down the interest rate when you could just put that money towards, having a lower mortgage balance. But with everything else, there could be something else that you want to put that money towards. So just wanted to kind of run the numbers, show you sort of the thought process when it comes to whether it makes sense to refinance or whether it makes sense to pay points or not, especially on a 15-year loan. Because again, I see it out there all the time. You see these teaser rates for 15-year loans, and they do involve the payment of points, and that might not necessarily make sense for your financial situation. So I hope this information is helpful. If you have any other questions or if you want me to run based upon your particular situation, more than happy to do that. Thank you so much. Let me know if you have any questions or need anything. Have a good day.